You need money to help start or grow your business. This video is going to show you some of the options that are available to you on how to finance that, and also some best practices and tips and tricks on how to set yourself up for success. So all that and nothing else coming up here. Hi, I'm Joe from Avalon Accounting, and today we're going to be talking about how to get financing for your small business. But first, if you haven't subscribed, please do so now. Like this video, and we're putting out lots of new content just like this, so please hit that subscribe button and get involved here at the channel. So without further ado, I'll give you the big rundown of how all of this works. And first I want to set up a bit of a primer here. So number one, when we talk about financing for your small business, we're talking about a couple things. So number one, we want to talk about whether you're financing your business as a startup or you're expanding your business. So those are sort of two different scenarios where you need financing. And the second component is whether you're financing for capital purchases like equipment or marketing to an extent, things that are going to pay off over the long term, or more operating needs. So that would be, meeting the next payroll, or you're in a period of losses and you're going to turn the corner, but you need more of an operating loan. So those are the two sort of scenarios there, and we'll dig into each one with each scenario. Next, we're going to talk a little bit about which options are available to you. And the number one is debt. So that would be any loans from a bank or a person. Number two is equity. That's giving up a portion of your business in return for either money or maybe some expertise. And number three is sweat equity, often forgotten, but part of every new startup and any business that's ever existed. Owner tends to put in a lot of effort for minimal money, especially in the first while. So that's a consideration to your equity position and how you're financing your startup. So those are the three big components of financing. All right, so the first option we're going to cover is debt. I know you probably know this already, but I'm going to say it anyways. Debt is a loan that you take from a bank or a person with a promise that you'll pay back, one, the principal, which is the amount you borrowed, and number two, interest. That's what's in it for them, some extra interest payment that they get for giving you the loan in the first place. So with that out of the way, I want to talk about when it's a good idea, what types of debt are there out there. So number one, the first type of debt I'm going to talk about is a term loan. So a term loan is where you take a loan and you promise to pay it back within a certain period. So you make regular monthly installments, say over 5 years, for financing maybe a piece of equipment. The second type is where you take a line of credit, which is essentially a bank account that can go into a negative balance. And you pay interest on the amount that was in a negative balance, at any given time. So those are the two major types of debt, and you'll use those in different situations. So a term loan would be used essentially when you are buying a piece of equipment and you can match those cash flows together. A 5-year piece of equipment that you have a 5-year loan for. A line of credit would be used if you maybe go into negative balances throughout the month. Maybe you collect your accounts receivable late in the month, but you still have to payroll early in the month, and you need some financing in the meantime to help cover those negative cash balances in the meantime. So that's the two major types. They both have their advantages and disadvantages, of course. You're going to pay more interest. You have to use that whole term loan, which is a good idea. Make sure you're using that cash that you've borrowed to its greatest extent. And with a line of credit, you want to make sure that you are popping back into a positive balance once in a while, or else, maybe a term loan is the better way to look at that. So those are the two major types. Now, for startup businesses, really challenging to get debt because you don't have a track record or trust. Banks and people are looking for a sure bet that they're going to get their money back and their interest. And the more risk you pose, the higher interest rate you're going to pay. So it's really important in the early days as startup, either to have good personal credit that you can apply against, or look for new other ways to get financing. And one of those other ways is using government-run programs like the Business Development Bank of Canada. They offer, quite expensive rates, but you can get loans from them for your startup, which is important. The number 2 place to go is, if you're a young entrepreneur, is to go to the Futurepreneur Network. Futurepreneur is a program that's government-run, and they offer some startup financing for young entrepreneurs under the age of 40. Next up, if you're a female entrepreneur, you can look at the Women's Enterprise Network. They offer lots of mentorship and loans for startup businesses for female founders. So that's a great place to look as well. But if you're more established business, what you're going to be looking at is showing the bank or another lending institution your 2 years of financial statements. And those should look pretty positive. If they're looking really bad, it's going to be harder to get a loan if you're not showing cash generation in that. So that's a consideration for both of those things. So the advantage with debt is that you don't give up a portion of your company. So you have a very clear set of guidelines that once you pay that money back, you have no further obligation. And that's really important, because if you are looking at growing your business and adding more value to it, you want to hold on to as much of that company as possible. And if you have debt, you're not giving up any of your equity in order to do that. And once you've paid off that piece of debt, you're done. So that's a great part of it. The downside is that you have immediate cash outflows most of the time, especially if you take a term loan. You're going to be making regular monthly payments, and that's going to be a cash outflow. So really critical to get whatever asset you are planning to purchase with that term loan up and running as quickly as possible so that it can start generating cash. So those are 2 real critical components to consider when you're looking at getting some debt. So the second type of financing that we're going to talk about is equity. Raising equity means giving up a portion of your company in exchange for a cash input or maybe some expertise that you couldn't afford otherwise. Now, the upside of having equity raises to get funding for your business is that you're not going to have any immediate cash outflows. The investors in this scenario will be looking for a longer term payoff, not a quick one like with a loan payment. The downside is that you are going to be giving up a portion of your company in perpetuity. So if you're looking to really grow in value over the short and long term, you're going to be giving up a good portion of that by raising equity. The other part of that is that you will have someone else to answer to. People give up their money and get equity in companies. They want a say in the game. A lot of them do, not everybody, but you are giving up a little bit of control of your company and how it's going to grow. Now, if you're a startup, a good place to start is with an angel investor. An angel investor is usually maybe independently wealthy person that likes to get businesses off the ground and help struggling new entrepreneurs. So good angel investors will be that independently wealthy type of person that is not too concerned about losing that investment. If you see someone that's angel investing, but they look like they really need this to pay off, the chances are they aren't a true angel investor. But these will usually be smaller amounts just to get you off the ground, and you may have to go back to them a few times as you grow, and they'll want to see some progress to give you those second, third payments. But that's a great place to start if you are looking at raising funds early on in your business. As you grow, you're going to want to be looking at Series A, Series B type investor tranches or investment series. And these are typically when you have shown proof of concept, you have a really good product, and you need more funding, more people, more equipment to get to the next level. So those are a little bit outside of what we typically deal with here at Avalon, but just useful to know that these are typically bigger investment rounds and come with a lot more strings attached. So how do you go about raising equity? So the number one thing that I can impart to you is network. This is so important. So people are going to be banking on, yes, your idea, but if they know you or can vouch for you, they're going to really be investing in you as a person in tandem with your idea. And what it comes down to is, are you a person that can execute on this idea? Ideas are a dime a dozen. What good people are the things that are really hard to find. So establishing a good network and people that trust you and can believe that you're going to be successful is really critical, and you'll have lots of people that you can reach out to for help. The third type of investment that you're going to be looking at, and is often forgotten, is sweat equity. And this can also be called bootstrapping, but it's essentially that you're working really hard for free for a while. You're giving up a portion of your pay so that the business can get through those rough early days where revenue is low and expenses are high. And one of those expenses is your salary, and you're going to be giving that up. So it is something to consider that you are working for some equity in the business. You're building value. It's not without compensation. It's just the compensation is in future value of the company. Now, the upside to sweat equity is that it's cheap. So you're giving up, your time and energy, but it's not expensive from a cash perspective. You are also giving up your energy. So it's important to consider that this will have a shelf life. You can't give up your money and your energy forever for free. So know that it does have a shelf life, but it is a good, cheap way to do that. The downside is that you can reach burnout, and we see this all the time. You have a good idea and you're going to be able to, hopefully execute on it, but there comes a point where you just get downtrodden or tired from all the work that it is. So just something to consider. You want to be careful with sweat equity. It is a really important component, but it does have a shelf life, and you'll want to get over that as soon as you possibly can in your business. All right, so we're going to wrap this video up with some best practices and tips and tricks on how to make financing work for you. So number one is keep up-to-date financial records. It's really critical. Investors and banks are going to want to see your latest financial results, and if they're not up to date and it takes you weeks and months to produce those, then you're going to lose trust and maybe lose out on that financing deal. So that's really critical, up-to-date financial records. Number two is network. Get a strong network going. Have people that trust you and that will have your back when the financing comes, and be able to introduce you to people that may be in their network as well. This can't be overstated. It's really important that people understand how lenders work and that they'll go the extra mile to get your deal done if they know you and trust you. Number three is plan ahead. Nothing worse than getting an 11th hour request for financing, and if it's not done, the world is going to explode. It's a really challenging place to put your banker, your accountant, your lawyer, and everybody involved. So plan ahead, look 3-6 months in advance, see when you might run out of cash, and plan for that. Get the process started early, and you'll be much better off. So those are the 3 big tips. Hopefully this video has been helpful for you to understand how to get financing for your small business, expand it, grow it, be more successful. And if you like the video, please subscribe if you haven't already. Like this video, comments, questions, and hey, any other tips that you have about financing for your small business, post them below. We'd love to hear them. We can always be adding to this video later. So love to hear everything that you have to offer. Cheers, and thanks so much.